Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and the Senior Portfolio Manager at McNichol & Associates Asset Management. Well, what do you want first? The good news or the bad news? All right, let's start with the good news. The good news is that so far, the S&P 500, the NASDAQ, and the S&P TSX indices have held at or over their immediate breakpoint support. The SG price for the Standard & Poor's being, of course, the critical one, being 3.5 times the adjusted book value. And then there's the HC price for the TSX, a humble 1.5 times adjusted book. As of yesterday, however, it was very close. The S&P actually hit its calculated S super growth price dead on. So the rebound, any rebound today, is definitely in order. As you can see from the numbers, however, the TSX is better value and is a lot cheaper than the Standard & Poor's. A rotation into the commodity stocks has been underway for a while, and the TSX definitely offers more value at less risk. Indeed, for some time now, we have actually generally avoided U.S. stocks for our SVA clients, as our SVA analysis has showed that the path of least resistance for the U.S. dollar has been down. If you'd like further information on this subject, you can download my compact version of my monograph, Black Hole Economics, which speaks volumes as to what's going on these days. Just Google Black Hole Economics, and it will come up. And now the bad news. Or if not the bad news, at least the worrisome news. Amazon and Apple, which have been solid bricks in my phantom FANG portfolio, have let go. Their support levels are in the process of rendering confirmed sell signals. Indeed, the FANGs in general, save for one, are giving me the heebie-jeebies, if you will forgive me for using a highly technical term that we investment cognoscenti like to employ in moments of stress. Anyway, before we take a close look at the FANGs, I do like to say thanks to everyone who likes this video and all our subscribers. I appreciate your help with the YouTube algorithm, as this allows us to bring you more and better content. So again, thank you for that. Okay, turning to the FANGs. Well, the first one is Amazon, and look at that breakdown. Good grief, this stock has been an absolute brick for months, and for longer than months and months and months. It's been just amazing at its breakpoint, and here it is having broken down. Now, of course, we'll watch it carefully. We don't have a confirmed breakdown yet, but on the other hand, I treat this very, very seriously, particularly as it is confirmed, if you like, by the breakdown in Apple as well. Now, what I want to say about Apple is that it is quite possible that there is a sea change occurring in this company brought by a change in corporate strategy. And I want to illustrate that by showing you the longer term view of the company. You'll notice for a long time, excuse me, when the balance sheet was growing nice and steadily, that the fair market value, which is that dotted line, tended very much to hold the price of Apple in check. However, a few years ago, Carl Icahn said to Tim Cook, hey, listen, you've got all that spare capital there. You should be paying that out and buying back stock. And the company indeed began to do that. Well, what happened when they did that is that the stock then broke out and has had a nice run. And I showed you the reason why, and that is to say that once you buy back stock, then providing your earnings, of course, don't collapse, but if your earnings carry on, then what happens is that the return on equity starts to rise. And what we have noticed with stock after stock is that in that case, then the valuation, that is to say the price to book, rises as well. Well, the question is, if you stop buying back stock, then what happens? Well, of course, your balance sheet starts to go up and your ROE starts to go down. And if the stock price falls to, and indeed perhaps below, the fair market value, well, I hate to tell you, but that's 47% below the current price. So if you're looking to turn a $2 trillion stock into a $1 trillion stock, that's the way to do it. Facebook, well, ever since we've first entered after that big correction and the move back to the mid super growth price, that's 5.5 times book value, we've been holding Facebook in our phantom portfolio, if you like, a little bit nervously, of course, and none more so than last week when the stock has actually broken below that mid super growth price again. However, for the moment, we'll just wait and see. Microsoft broke out and actually for more than 3 weeks held up beautifully above its HB2 price, which is 12 times its book value. Now, last week with everything else, Microsoft has broken back down too. I will watch that one somewhat nervously. NVIDIA tried to break out. We never got a confirmation of that, so it remains outside of my FANG portfolio. But I also have to say that kind of action that we're looking at in NVIDIA often bespeaks lower prices, not higher prices. Netflix, I haven't held for a long time, and continue to feel the same way. Finally, the one bright spot, if you like, in the FANG portfolio is Alphabet. Alphabet broke out very, very strongly. I think it's now in the process of pulling back there to its mid super growth price. That's 5.5 times book value. I like the fact that the earnings and the fair market value are turning up, and I think if the stock pulled back to the MSG price, might be a question of even buying a little bit more. So, in summary, last week I observed that if there was a good time to buy Amazon, it was right then, precisely last week, at the HB3 price, or 16 times book. I did, perhaps wisely, add that I would be watching that HB3 price a little nervously, and I stated it had better hold. Well, it didn't. Turning to Apple, last week I noted things had changed unexpectedly. Tim Cook had really crossed the market up and stopped buying back stock. Whether it's for the moment or not, I don't know, but we'll call it for the moment at least. Do you remember a few months ago I set out the process for turning this $2 trillion market cap stock into a $4 trillion market cap stock? And I showed you how it could actually be done. Well, unhappily this week, I also showed you how to turn a $2 trillion stock into a $1 trillion stock. This is not funny, Tim. The stock has plunged sharply, rendering a short-term sell signal, although I hope that we get a bit of a rally in the market and mitigate some of that loss. Last week I had noted that Facebook was a bit wobbly. And this week it had wobbled back down through support at its mid-super growth price. As you're aware, I've held this stock for some time, nervously, I'll have to say. And the evidence shows that the market is about as nervous about the shares as I am. I'd welcomed Microsoft into our Phantom portfolio with that breakout over its HB2 price, 12 times book, which had managed to maintain for 19 days. Due, of course, to that nice little fill-up in earnings. However, that breakout was nothing like Alphabet's in terms of percentage gains and follow-through. And as I said at the time, I am not yet a true believer. This week, like Facebook, the stock is again a bit wobbly. I will stand pat, but nervously. Nvidia refuses to confirm its breakout and slip back under the waves again. Netflix, for all those nice numbers and even that little fill-up in its earnings trend, has yet to offer investors any satisfaction. Personally, I still would not own the shares. The one bright spot among the FANGs is Alphabet. Alphabet has broken out nicely over its mid-super growth price, 5.5 times book, and is now doing that breakout pullback routine that many stocks go through and that I usually warn you to be aware of. The buy signal was strong enough that I hope will allow the stock to hold above the MSG price. So, similar to last week, my first takeaway this week is that the market continues to dither, having actually hit its super growth price, that's 3.5 times adjusted book, with dead precision. However, 1.9 trillion in stimulus spending promises to hit the market sometime in the next month or two, and I, for one, am unprepared to try to guess what the stock and bond market outcome of that will be. Second, the FANGs are certainly not the leaders that they once were. In fact, if anything, they seem to be followers or worse, maybe trying to lead on the downside, as I think you saw very clearly today. Talk about dithering, I might say. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday. Until then, stay safe. This pandemic is not over yet.